Good morning, everybody. It's the best day of the week. It's Sunday. It's 9:55 a.m. Pacific Standard Time, and the date is 6/8 of 2014. And we're going to feature the S&P 500 once again. And on the monthly level, we are at 97.98% overbought, and we are. The other thing that we're going to add in the highlight is the January of 2014 when we opened at 1845. The high for that month was 1850. However, if you do the math and take 1850, we sold off in the calendar month of January to 1770.45 with the closing of 1782.59, and at that point in time when that happened, we were at 91.81% overbought at that level, historically speaking. Then on the calendar of 2/1/2014, the S&P 500 opened at 1782, and we rallied up within that monthly time structure to 1867, which was this high right here. And I will let you know that this bottom in the S&P in February was 1737. From that point in time, we took that rising 10-month moving average. We had a low and we had a narrow range month for 3/1, and we also had a narrow range month for the calendar of April of 2014 with an 1873 open and once again an 1897 high. But from that high level, MMTs, in that month of April, we went down to 1814 in the S&P, and that was that bottom. And from 1814.36 low, the next month, which is the month of May, we opened at 1884. We made a high of 1924, but that monthly low in May was the 1856.79 with a closing bell of a 1923.57. And that was the monthly low. And you need to benchmark it, because what has happened now, starting out the month of 6/1, this is the 8th day of a Sunday, and not only that, we opened at 1923. We make the high from 23, we make the high of 1949, and that was the high. But here is the deal. We also had the low on the last trading day of 1915, and we closed at 1949.44. So basically, we're right in the middle of the calendar year with a 200-point rally off of the bottom, and it's very clearly, and not only is it very clearly, it's one of the most overbought markets in that time frame to have a 212-point rally from the month of February 1737 to 1949. And each time that we hit a low, there was an algorithm called high frequency algorithm that was bidding up all 10 sectors in the S&P 500. Part of the analysis that we've done today, and we basically have taken all of the S&P 500 stocks, and what we have done is we have done what we always do. And when we're looking at overbought levels in the S&P 500, we focus on this. We focus on the daily percent DS. We focus on the weekly percent DS column and the monthly. The higher that these numbers are, the most overbought these names are in the S&P. It was these stocks here that all, it's the stocks within the S&P that are extremely overbought, all at the very same point. Well, let me just tell you something right now up front, is that us as human beings cannot be that accurately right. We just can't. And we know when there is an algorithm that is being used to push all 10 sectors within the S&P 500. So having said that, we are also going to take a look. We already know what the equities are in here that were used. And all of these equities are also as overbought because nothing can stay up there. One of the things that I'm going to do is I'm going to take down this monthly chart for the moment. Here we go. We're going to take a look at the call and put ratio. Right now, we are about as lopsided between the call and the put ratio. We have strike prices, and these are July contracts, monthly contracts on the S&P. What I am going to show is the 1950 call on the S&P. This call is a call chart, and most people have never even seen one, but yet they want to try to trade options, okay? Now, that's where this is an extremely inflated value. Now, on the put side of the market, you can see how deflated that this July contract is and whatnot. So it's a monthly. It's June 6th, the last trading day, and that these contracts hit a low of $27. The volume was 2,254 contracts. Okay, so therefore people were really buying that up. So basically, when I am showing mathematically the imbalance of these indexes on a daily call and put ratio, that's that inflated value of the $1,950 call, and they can't go much higher. That means that this side of the market, between the both sides, is that the imbalance market ratio is at absurdity levels. And there is going to be something that is going to have a major pullback, is going to be right around the corner. And we always look at the put to call ratio at various strike prices to determine that when they were here at 20, they were at absurd levels. And when they get to absurdity, here's what happens. They go straight down. And when they get overbought, they go straight down. Listen, this algorithm has pushed the S&P 500 to absurdity levels, mathematically speaking. So therefore, this side of the market will be coming down throughout the month of June and going into the month of July. One of the things that we're going to be showing the MMTs and the rest of the world is that this is a June monthly regular 1920 call that is up here to absurdity levels. Now, having said that, in this contract prior, we can see clearly when they get inflated what happens. And we can clearly see that when they get inflated up here, they get deflated. And that low was $3.70. And this inflated 1920 call, which is where the S&P broke out, is absurdity levels. Now, on the flip side of the June contract, we are going to let you see the monthly high of that $1,920 put. And the high was exactly $106. Now, this side of the market, my friends, is the most ridiculous put to call ratio than I have seen in a number of calendar years, and I've been around 30 years, or longer than 30 years in this game. And what I am saying is that this side of the market is the most deflated and the most inflated. Once again, June 1920 call. Once again, a put chart. That's the value of these contracts right now. And the value of these contracts were down here at $4.60. There will be a rebalancing of the put to call ratio as we can see it here. This is what it looks like. And these are the lows. MMTs, we have before us right now a 1900 put that expires in June on the third calendar week of the month. This thing here, when you want to talk about a week ago, look at what happens, what's normal. They get inflated, they go straight down, okay? And then they go straight down, and then they come up. Last week, they were inflated, they were. And now they gapped it up, and now we're at such absurd levels that there is a big drop coming in that $1,900 call, a monthly expiration. If we take a look at the $1,900 put, these were $176 back on February 2nd. Now, check this out. They're worth $2.20. That is what has happened to the institutions and the big time traders on the June contracts. As I have said, in the month of June, we had seen record buying highs of the put contracts. And since those big purchases have been made, they have totally marked these things down from $176 to $2.20. Give me a break. I have never, ever in my life, trading options for all of my life, have I ever seen something this call put to ratio that mathematically imbalanced. I'm also featuring a 1920 put for July, the third calendar week, called a monthly expiration. Now, these highs were up here at $64. This low right here on this particular contract, the 1920 put, they have marked this thing down to the low of $17. That is the July contract. That's just how deflated these $1,920 puts are. Now, on the flip side of that, whole deal, we are going to show here the calendar monthly high of the $1,920 call, which is just the opposite side. And the highs have hit in this monthly level. They were $10, and now they are currently at the lows here were right around, let's say, $10 and some change. Here is an easy way also to take a look at a daily contract on the July calendar third month. We have gone parabolically up, totally absurd, high frequency algorithms involved. The low of this contract was at one point $10.60. Now they're $42. Now, just the flip side of that is the $1,920 put has been marked down here, just the opposite end here. We can clearly see that these were like almost $64 and now they're $17. Calendar month of July, third calendar month of July, and I'm going to move right along. What I'm showing is my big money players is that the low here of that call was at $3.80, and this is a 1950, and this is a third calendar month of July, and we're up here at $24 on the high, period. It's inflated. And you know, here we are on the opposite side of the $1,950 put. That is totally deflated. And what month? It is July, third calendar week of July. We are looking at a July call, third month, 1900 now. And the low was, at that point, $18. And for this monthly July contract, we're extremely overbought in the contract, and the high is $58. Now remember, MMTs, third week of July, this S&P is going to expire. Now, let's take a look over here. We have a lot of support on the S&P at 1900. That would mean from the overbought level in the index itself would trade down to the 1900 in this volatility, that this contract, the low, is $12. Here was the high right here. $60.12 on the $1,900 put. Now the value is $12. That value here is totally deflated and lopsided to the call and put ratio contracts. MMTs, I have before us right now that S&P 500 chart, and I have shown the June contracts call and put ratio for June, third calendar week, and I've also showed the July third calendar week, which is a monthly expiration, not a weekly. Now here's what I'm going to show you on a daily chart of the S&P. Here we are at the high. Now, on a daily format, we are 98.21% totally overbought to such absurd levels on this daily chart. And yes, we had where the algorithm mathematically has pushing those sectors higher in that S&P to drive these at absurd levels of 98.21% overbought. There is a big correction that is coming, and no one's going to stop it. You got to remember that it was a software generated program that bid up all 10 sectors in the S&P simultaneously to such absurdity levels of overbought, with a 200-point rally back over here, a 212-point rally from here to here. And I'm saying that we are going to pull back, and there's going to be a lot of selling. Nothing is on sale, and that is the mathematical algorithm that has pushed these things to such absurd levels that most people that I have talked to have not seen a 98.21% overbought. Not only that, this is the SMF system. This is the Excel side. Date, open, high, low, close, and volume. Now, we have to show our big traders how overbought this S&P is. And what we're going to say is that the dark orange, normally this would be green, but we've color coded it to dark orange or red, and this is the time down here to be so overbought on the on-balance volume here. And when we start looking at the 5-day, the 10-day, the 20-day, and the 30 and the 50. Of course, listen, we are extremely overbought. We are going to come down. This is telling us, listen, normally when that green is there, that would normally be red. And they came in and they bought it and they used it. And I'm telling all my MMTs and all my friends during my whole life, this is how overbought that the on-balance volume is. And most of the rally was done. And here's a 2-day performance, 21.56. Here, on a 5-day performance, the S&P advanced 25.827. You start looking at 10 days in total advance. The more darker it gets, the more overbought it is. The 20-day level, open, high, low, close, is dark at 70.96. This is coming down. And on the 50-day, well, my goodness, it's at a 100-day run in 50 days, and it has. And in the shorter time frame, on the 10-day, when we do get overbought on the S&P, we're going to come down, and this is how we look at our format mathematically. When we take a look at where the highs were on a 7-daily high and a 7-daily low of 1909, these were big ranges from that bottom up of 1950 that I was talking about on a 6-daily low to a 7-daily high of 1949. However, the 7-daily low was also 1908. And then we flipped it right back. And that high in the market will stay there. The 12 daily low where it broke out was on this calendar date, which was the June 6th area. On a 12 daily low now was 1873. Of course, 1949 isn't going to change. And listen, where we had 1862 on the S&P with the 21 daily low in the price was 1862.36. And then ultimately we had 28 daily lows of 1850, and there were periods that we talked about at 1860.29 on a 28 daily low in our format, which is our system proprietary. And I'm telling all the big people, it doesn't matter how much money you have or if you have a little bit. This market is extremely overbought. It's going to be a two-part series. It's going to be the June contract, call and put, July calls and puts. The imbalance ratios mathematically cannot and will not stay the same.